Right, welcome to Lecture 5B, Part 1. Before we kick off with the lecture, let's do a quick review from Lecture 5A. So, what is the general formula for calculating cost of goods sold? So if you recall, and this really works for any kind of inventory, it is beginning inventory plus purchases minus ending inventory equals cost of goods sold. Okay? So, today's lecture is going to cover accounting for inventory sales. Up until now, we've just looked at purchasing, so now this is the flip side. You've bought it, you've got it, now you got to sell it to make some money, right? And then we're going to briefly look at the adjusting entries and closing entries for merchandising operation. So, selling services had one entry, right? When we sold services, all we did was we debited accounts receivable or cash and credited service revenue. But now that we have inventory to deal with, that gets a little bit more complicated. It's not enormously so, but the first entry that we're going to deal with is going to look remarkably like the service entry. So we're going to debit cash or accounts receivable and credit sales revenue, not service revenue, but pretty much the same thing. However, there's another side to this entry because now that we've sold these goods, they're no longer in our inventory, and so we have to adjust the value of our inventory on our accounting books, and therefore we do this second entry, debit cost of goods sold, which is the expense, credit inventory, to reduce inventory. However, very important distinction we got to make here. When we sell something, we record it at the selling price, right? Makes sense. So this is at the selling price. However, inventory is not kept at its selling price. It's kept at its cost, right? So that's how much it cost us to buy the inventory plus any freight in that we might have had to pay minus any discounts that we got for prompt payment or for a volume purchase. So the inventory is not kept at the same selling price. It is kept at cost, and therefore it is going to be recorded. The transaction to reduce inventory is going to be recorded at cost, right? Now this should kind of make sense. Selling price and cost, those two dimensions, if you will, to the selling transaction. And obviously the difference between the two is the profit on your sale. Okay. So having sold the inventory, and let's say that we've done it on credit, so for an account receivable, when we go to collect, what happens? Well, the account receivable gets zeroed out. If they take a discount, then obviously we're going to get cash, but a lesser amount. And we're going to then plug the difference to this account called sales discounts. Okay? Now, when we bought stuff and we got a purchase discount, where did it go? It went into inventory. Same place that freight went in and everything else. That's because of the cost principle that says that something is worth basically what you paid for it at that point in time, right? And so or to get it to its intended purpose, which was to sit in your warehouse or your store shelf and in a sellable condition. However, when we're now selling something, we're going to, instead of trying to stick it in some big account like inventory, we're going to keep it separate because, really for two reasons. First, we want to know how much discounts we're offering on sales. We want to know how much money, how much cash we are losing out by virtue of offering these prompt payment discounts, right? And so if it's too much, maybe we're going to reduce it. Maybe instead of giving 2% 10 days, we're going to reduce it down to 1% in 10 days, something like that, right? So we want to be able to track that at the end of the year to know how much cash it cost us to get this prompt payment. And the other reason is there really is nowhere else to put it. I mean, if you think of it, the account receivable dollar value here has to correspond with the account receivable amount up there. Cash has to correspond with the physical amount of cash that you got, what they paid you with the check, and so the difference has to go somewhere, and there's no other obvious place. So it goes to its own sales discount account. Okay, so let's do a little example just to kind of help solidify the concept here, right? So Liz Claiborne sells $80,000 worth of women's sportswear to the Bay under the credit terms of 2 and 10 net 30 on August 1st. Their cost of the goods is $38,000, and Liz Claiborne receives the appropriate amount of cash from the Bay, blah, blah, blah. Assume that they use the perpetual inventory system, which is the only one that we know. Journalize their transactions. Okay, so on the 1st of August, 1 August, what happens? Well, they sell $80,000 worth of stuff, right? So we're going to debit accounts receivable, $80,000. And had they been paid cash, we would have debited cash. But we know, because they talk about credit terms, that it's account receivable. And sales revenue, $80,000. Same entry. Got to adjust inventory, right? So debit the expense account, cost of goods sold, $38,000, and credit inventory, $38,000. So this is basically the asset account inventory being converted into the expense of cost of goods sold, right? And then on the 10th of August, they get paid. So from the 1st to the 10th is inside this 2% 10-day discount period. So we know that there's going to be a discount. We know they're going to get cash, and there's going to be a sales discount. And obviously, we're going to wipe out the receivable, so we have to credit. So we're going to credit the account receivable for the $80,000. That takes care of that. And the discount then is going to be 2% of that $80,000, right? Which happens to work out to $1,600. And then the plug goes to cash, $78,400. I'm kind of encroached on my numbers here, but oh well. Okay, so hopefully that makes sense to you. This is the exact same kind of entry that you would see in the purchasing side, except that we're dealing with accounts receivable instead of payable, and it's cash coming in, not going out, right? But the calculation and the makeup of the entry is pretty much the same. It's just we're using sales discount now instead of inventory. So hopefully that's kind of familiar. The key piece that you guys need to wrap your heads around and understand and never forget is when you're selling merchandise, you will always have two pieces to this one entry: the sales piece and the inventory piece. All right. So sometimes when we sell things, just like when we buy things, we ship the wrong goods and they get returned, or they get damaged, or they were defective or expired or whatever, and they're unsellable. And therefore, we also need to be able to account for the fact that sometimes some of these goods get returned and other times they just get junked, and we give the buyer an allowance. Now, we need to keep track of these two things separately, and I'll explain why in a second, right? So, some key definitions, though. If it can be resold, then it is a return, right? However, if it's not, if it's just damaged, junk, garbage, in any way not returned, then we're talking about giving the buyer an allowance, okay? Now, why is this important? Well, both returns and allowances will have this first entry, okay? Which simply lowers the amount that we owe, right? It's going to reduce the account receivable or refund them cash if they paid with cash. And it is going to debit this account, sales returns and allowances. And I'll talk about that account in a second. But if you have a return, so if there's a return, then you also need to adjust inventory because the product is coming back into your warehouse, and therefore you have to increase inventory and obviously reduce then the cost of goods sold component as well. Okay, so if only if it's returned, you have the second entry as well. If it's not returned, right, so if it's just rotten fruit or something like that, you'll give them a credit, and they'll just throw the stuff, the merchandise, in the garbage. Okay, so now, question. why sales returns and allowances? Why don't we simply reduce the, why don't we simply debit sales revenue? Well, what we want to know is we would like to keep track of how much of our stuff is being returned, right? Particularly if you're like the owner of the business and you have somebody else running it for you. Having an idea of how much of the stuff that you sell is returned speaks to quality, right? So what can make this number go up is poor quality can drive increased or elevated levels of sales returns. And so having an idea of where your products, how they're perceived in the marketplace can be important. And so tracking this information in its own account gives us that ability. However, it has a normal debit balance, which would suggest that it's an expense, but in actual fact, it's a contra revenue account. Okay, so sales returns and allowances is a contra revenue account, and you'll see when we look at merchandising financial statements shortly how it gets represented. But as a contra revenue account, it will be netted against revenue, just like accumulated amortization gets netted against fixed assets, right? So when it's presented in financial statements, it shows up as a little deduction from revenue to get net sales revenue. And that's why we can keep it as its own separate account here. We can look at the dollar value in there to get a sense of how much of our product's being returned, but for presentation and to keep doing things properly, it will be netted against sales. Okay, so let's do a little example here. So suppose Pearson Education sells 1,000 books on account for $75. That's the cost of the books on October 10th, blah, blah, blah. 100 of them were the wrong edition. So Pearson later received these books as a sales return. Okay, so now we have to make the two entries, not just an allowance, but an actual restocking as well. Okay, so journalize this. All right, so let's look at the 10th of October. We sell stuff. Accounts receivable for 1,000 books, $75 each, $75,000. Sales revenue, $75,000. And in the same breath, cost of goods sold, credit, inventory, $50,000. Okay, so that was the 10th. 100 of them were the wrong edition, and they got them returned on the 13th. Okay, so on the whoops, let's fix that. On the 13th of October, they were returned, right? And so that then means that we're going to debit this new account called Sales Returns and Allowances. And how much? 100 books, $75 each, so $7,500. And we're going to credit accounts receivable to reflect the fact that the customer owes $7,500 less. But because they were a return, we also have to do the inventory entry. So inventory goes back up. Debit inventory, credit cost of goods sold. And how much? Well, if 1,000 books cost $50,000, then one book costs $50, and 100 books will cost $5,000, right? And so that's how we know how much to record on the cost basis for the inventory transaction. All right. Now, the final piece of the puzzle is they get paid. They get paid on the 22nd, which is terms are 2 and 15, so that's inside the discount period. So 22 October, they're going to get paid cash. There's going to be a sales discount. And we're going to reduce or eliminate the account receivable. So how much is the account receivable now? Well, it started out as $75,000, but it's been decreased by $7,500, so the account receivable is $67,500. Cash then, the discount was 2%, 2% times the $67,500, which is $1,300. And so cash becomes $66,200. 200 to make the entry balance. And we'll conclude the next, or we'll carry on in the next part of the lecture, part 2.